This is what nobody tells you about financial goals. Most people don't fail because they lack money. They fail because they never build a system that forces money to behave on purpose, and every dollar without direction immediately gets absorbed by lifestyle, debt, or randomness. So the first action is to treat your financial life like a controlled operating system where nothing is accidental anymore, starting with writing down your exact current monthly income after taxes using your real US paycheck from your employer, not your advertised salary, and pulling your last 2 bank statements from institutions like Chase Bank or Bank of America so you can see the exact inflow pattern, then immediately recording every recurring expense you see in those statements without judgment so you establish a baseline that is brutally honest and not theoretical. Every day you delay this, you lose money because financial blindness compounds faster than interest, so the next action is to open a single document or spreadsheet and separate your money into fixed categories based on reality, not intention, starting with housing, utilities, food, transportation, insurance, and debt obligations, then marking every transaction from your last 30 days into those categories manually so you understand exactly where your money actually goes, and this must be done using your real transaction history from your debit card, credit card, and mobile payment apps because guessing destroys accuracy, and accuracy is the foundation of all financial goal setting in the US system. The wealthy already use this system quietly. They never treat income as spending money until it is assigned. So the next step is calculating your true monthly survival cost by isolating only the expenses required to keep your life stable, including rent or mortgage, minimum debt payments, basic groceries, basic transportation like gas or public transit, and essential insurance, then subtracting this number from your net income to reveal your actual deployable capital. Because without this number, you are building financial goals on illusion instead of capacity. Most beginners fail right at this exact step because they confuse budgeting with restriction instead of allocation. So now you immediately restructure your financial identity by separating accounts into purpose-driven buckets using your bank's online system, or opening additional accounts at a credit union if needed, and setting up one account for bills, one for savings, and one for discretionary spending. So every dollar entering your system at places like Wells Fargo or similar institutions is automatically labeled by function instead of emotion. This is where control over your money starts. You now build a minimum emergency buffer by transferring a small but consistent portion of every paycheck into a high-yield savings account until you reach at least 1 month of survival expenses. Then, scaling toward 3 months. Because in the US financial environment, unexpected layoffs, medical costs, and car repairs are structural risks, not rare events. And without this buffer, every financial goal collapses the moment instability appears. This is where real opportunities open up. Once your baseline stability is defined, you convert vague goals like save more money into precise targets tied to time and function, such as building a specific dollar amount for emergency funds, debt elimination, investing capital, and skill development. And each category must have a numeric target tied to a deadline based on your paycheck frequency, not abstract yearly dreams. This single step changes your entire outcome. You now translate every financial goal into monthly execution numbers by dividing your targets by the number of pay periods in your work schedule. So if you are paid bi-weekly, you calculate exactly how much must be moved per paycheck into each category so your goals happen automatically instead of being decided emotionally at the end of the month. This is where people unknowingly lose thousands. They carry debt without mapping it clearly, so you now pull every credit card, personal loan, student loan, and medical debt record into one structured view using official statements or credit reports from agencies like Experian, and you write down balance, interest rate, and minimum payment for each so you can see the true cost of financial delay. This is how the system actually works behind the scenes. Credit scoring and lending decisions in the US are driven heavily by utilization and payment history, so you immediately check your credit utilization ratio by dividing total credit card balances by total credit limits, and your goal becomes reducing this percentage by paying down balances strategically instead of randomly, starting with high-interest accounts first.